Consider that we're going to create an ETF. How do we do it? And here we're going to summarize the simple procedure to create a portfolio or of or ETF or any type of fund based on the quantitative active investment strategy. Well, I'm going to do is using my index and ETF, called U-Turn X and U-Turn as example. Now, first is that I have to have a methodology that able to or model. That model actually had the theoretical background that able to show had the prediction power or the forecasting power. So we had a designing or forecasting a model there. So this model has been defined based on a methodology. All right. With this methodology, what is the next step to do? Is how do you create a portfolio? First of all, you have to have the investment population. So we need to do here is to look at that some of the data. All right. So we look at a company mapping. Now we look at their different type of company. We look at the different groups of firm stocks, and we try to identify that. Take U-turn for example, because if you're targeting the short-term reversal, you're going to involve a lot of what we call the frequent rebalance, and the U-turn is going to rebalance on the weekly basis. So rebalance meaning you have to buy sell the stock every week, and then there's a lot of amount. For example, suppose the fund is say $50 million, right? Then $50 million you have to change him every week. So you gotta sell it and then you gotta buy it. If it's 25, that's a 50 stocks. So you have to find some company mapping that able to for you to do, which is you can sell and buy without interrupt your price. So liquidity is the first. So that's related to the company mapping. The fundamental here, it relate depend. For U-turn, the first fundamental is not an issue, but some other methodology. For example, there's a ETF called revenue shares. Revenue is based on the sales, so they're taking advantage of the company with different sales. So if that being the case, then the fundamental data like sales data or say revenue data or maybe the expenditure data is important. Then also we also have different type of survey data. It could be in a company level, a market, or economic level. Now these type of survey data for some of the methodology are very important because they're using different timing strategy. Now for U-turn, that is not an issue. And other conventional data you need to know, you need to have to really actually catch your basic model. For example, the news sentiment, all right, consumer supplier chain, consumer and supplier chain, corporate event, many other type of information that could use and crucial for some of the methodology. Just keep in your mind there are 1,000 different type of ETF and mutual fund. Each fund or ETF have their own strategy. Right? Otherwise, why people want to buy your ETF? If it is same as the market as the S&P 500, why should we do that? So that's important for us to understand that. All right, each one had their own character. All right, after you have all those mapping and you have the model, then what is the next? It's just like you have you create a airplane, then you have to have a test fly, and a test fly, and that test extremely important. It's more like a simulation type stuff. So we do the same thing is we apply the model to the historical data. Okay, so employ this called auto sample analysis. What does that mean? It's called auto sample is that you even though you're using historical data, but you implement your strategy ahead of date of the return. For example, if you are weekly rebalance, so you are doing the information on the prior information as be say for example in my case is every Wednesday to Tuesday. So you are using prior weeks Wednesday to Tuesday information and then use that information to create your selection criteria and you hold that portfolio for the next week. Okay, so you do that over 52 weeks a year, and so you do 10 years, then you have 520 weeks, and you do that one, and you see what happened to the return if every Tuesday you implement your strategy. Okay, so this we call back test. Now, if you see your return consistently, right, over the time, right, actually on average outperform the market, then your strategy has some value. Okay. Now, finally, you need to do a risk analysis, all right, and then you need to do a hypothetical trading cost simulation because in the real time, now because the test you have is a back test. In order to implement your strategy to the real time transaction, then you have to understand the risk potential here. What happened is during your testing period time, you may not involve in some kind of market shock or some other unpredictable event. Now, the market is very, very dynamic and moves so fast and it's very uncertain. So it's important for us to see what happened if something happened, right? So to estimate the potential risk for the portfolio and considering, all right, different position and the correlation under different market condition. Okay, so that is risk analysis, and you have to build a model to do that to see it whether you have power to survive under that distress. And another is trading costs. Of course, trading costs including two things: commission trading costs, buy, sell, and another one is the market impact. Sometimes the market volatility moving so fast, and then during that your rebalance, your costs involved may not be the same as you predict from your model based on historical data. All right, so there's another one. Trading cost is also an important factor. There are four main equity investment style strategy. Here we talk about style, and then we already discussed before. All right, investment style, and in terms of the strategy, there's actually four: value, growth, all right, market orient, and the market capitalization. All right. And this is pretty straightforward. We already discussed, so I'm not going to spend too much time to explain that again to you. Please read my note, and I summarize some of the key factor and key to distinguish these four different methods. How do we identify style portfolio? Okay, the portfolio style identification. There's two approaches. One is use the return base, and one is the holding base. We have discussed that in the previous notes. And then this time, I like to do here is to summarize it and make sure that everybody understand that there are two basic approach to determine or identify portfolio style, like growth versus value, for example. So, what's the difference here? The holding base, we characterize the individual security by their characteristic to determine the style. All right, so for example, we are using one, two, three, four, five, six different, um, you know, the fundamental character like PE ratio, PB ratio, dividend yield, forecast earning growth rate, and dividend payout, earning variability, or mean the volatility, or industry sector, and so on. So we're using this one to distinguish security between growth and value. Okay, so if this growth stock say, we use if the P/E ratio greater than the market average. Otherwise, if it's lower than the market average, that's the value. So you have a dividend yield, all right? The dividend yield, if it is less than the market average, that is growth. Greater than the market average, that is the value, and so on. You take a look at that one. Now, the growth firm had lower earning variability, and the value firm had a greater earnings variability. But these are, just using a different character to distinguish growth and value, and you can sort that for the multiple matrix sort to do it. Now another one is simpler. It's just like, let's run a regression. So you regress the return of managers fund, all right, against the return for different security. All right. This we call the star index. We already discussed before. It's like a multi-factor regression model, and the factor are those, fundamental factor like size factor, like the value factor, and so on. Right. So small minus big, high minus low. I believe you still remember that. So you do that one and you regret that, you get a beta coefficient. So you see how high the beta is. Higher the beta meaning what? Higher sensitivity to that particular style factor. Like if a higher size beta, meaning that security can be classified by as a growth or high risk security. Okay. And another one, once in addition to beta, another one you need to use information ratio. You want to have a positive information ratio. So what is the information ratio? You remember that? Information ratio is the average excess return divided by the volatility of excess return. Right? So excess return means alpha. Right? Alpha, remember, this was alpha over the volatility of excess return. This is called information ratio. Higher the information ratio means what? Higher the risk adjusted alpha. So that way it's also ensure you have a lower tracking error, and is able to effectively deliver active return. Okay, so this is the value, the outcome from positive information ratio. So using the beta and our information ratio, we're able to ensure that particular security belong to either, for example, growth or value, or large or small, and so on. Doesn't mean we're not using their fundamental character to do it. Instead, we're using the beta and the information ratio for a checking purpose. Now, here it's important. Let's discuss advantage and disadvantage of using that. The advantage of using the first one, remember, is called a return-based approach. This is the holding base. If we use the regression approach, which is a return-based, the return-based approach, Then the advantage of using that one is that because we run regression for the all securities, so we analyze the entire portfolio. That's the one advantage. Where the advantage for the holding based approach is that because we look at that each component, right, each individual stock, so we analyze each position. Now here is talking about entire portfolio, here is talking about each position there. So there are some different advantage of this. One, another advantage is for the return base is we're going to use the entire they have a theoretical model because based on the multi-factor regression model. And actually, we don't have to really get all the information about the company's character, so it's cost effective. However, the the holding based approach, since we look at that each position there, so we're able to quickly capture the style shift, the drift from one to another one, right? The style change, so we can catch that very quickly. Where the return base, you can't do it. Some limitation here for the return base, since we're using regression model, so you ignore the fundamental character, so cannot characterize the current style, right? And incorrect due to the style drift. Also, because you're using a hypothetical model, so you're going to involve the model misspecification. That is another major limitation of using return base. Now the holding base, since you're going to look at every individual security's character, so it's require you have more data, all right? And unfortunately, sometimes the data you may not get it because there is insufficient of data for some smaller company. And another one, since you're using an arbitrary selected character, then it's subject to your own judgment. It's subjective judgment. Right? So that is another drawback or limitation for the holding based approach. Okay. Also in my notes, I summarize how do we assign the style to a security. Now you may take a look at this one. All right, it's pretty straightforward. I don't have to, describe that or explain it again. But I do need to explain it to you about Morningstar equity style box. Now we have use that style box. The style box, according to Morningstar, is a 3x3 matrix between size and value. The size classified by large, medium, and small, and the value is the value, blend, and growth. So why this kind of box is important for us? Because you remember a portfolio is a basket of different securities. So in order for us to look at that, what type of the style of your portfolio, we can put our security into this 9 cells of the matrix and look at the percentage of occupation in each cell. All right, like in this example here, the majority, 60% of our security is in these cells at small cap value. And the second largest is the mid cap value. So basically, you know that this fund, it's a value fund. It's not a growth fund because you see the growth is a very small portion. So it is the value fund, but it's not large cap. It's only 2%. It's a small cap value fund. Okay, so it's a small cap value fund. Now, why that's important? Because if you want to change your style, all you need to do is what? Shift from one cell to the other. All right. to the other. You could migrate from this one to the other one, but make sure that here we're talking about active management, right? If it's a passive, you can't, but the active, you can move around on this 9 different choices here, right? Based on your IPS, based on your customer require, you can customize that. So the Morningstar equity style box provide us a very convenient tool that we able to see the style of our portfolio based on different allocation of our security into those this matrix. And then it's easy for us to explain to our client.